so lovely to have you guys here again. If you're just joining us for the first time, my name is Sefa, and this channel is called The Life of a Christian Girl, where we talk about our spiritual life, we talk about our finances, and we also have relationship gist that edify. So please make sure you click the subscription button and you like this video and you also share it with your friends. And for those of you that are our regulars, welcome back to the channel. Today I'm going to be talking about other kind of middle to short-term money market instruments that you can invest your money in, platforms where you can invest and earn an ROI in 360 days or less. Important thing of investing in money market instruments is that you also get your principal back. It's not like capital markets or buying stocks where you don't get your principal back. If you haven't watched that video talking about buying shares or buying stocks, please find the video and watch it so it can give you some insight into the video that we're about to have today. Okay, so going straight into the video, we're going to be talking about money market instruments that have 360 days or less, that as a low to middle income earner you can invest and have maximum ROI, that's return on investment. One thing I want to clarify is this: investment is not a Ponzi scheme. A lot of people come to my DM asking me that, okay, can I get a 50% ROI? And when I tell them that if you invest your money in this particular instrument or in this particular security in the money market, you are likely to get 22 or 20% or an 18% return on investment. And they're like, 22% is small. And I'm like, 22% is small. Compared to the level of inflation, right? 20% is actually not small. So you should not expect to have a 50% return, although there's some investments which we'll be discussing later where you can have high return on your investment. But you must understand this: the higher the return, the higher the risk. So if you're not a risk taker, I would recommend that you go for money market instruments. However, if you are a risk taker when it comes to investment, then we would have another video where we talk about high yield investments or investment platforms or investment assets. Money market is a financial kind of market. It's a kind of financial market where companies or banks go to sort for short-term funding or funding for 365 days or less, and investors can invest in these instruments or money market instruments and earn an ROI for 365 days or less. And some kind of instruments that are traded on the money market are commercial papers, treasury bills, certificates of deposits, fixed deposits. You have treasury bills. Those are some instruments that are traded on the money market. Now, why do I recommend money market investments for middle to low income earners? In the previous video, I had earlier said that middle to low income earners are those that are earning 200k and below. If you're not earning 200k and below, you are agba, like you have passed our level. But if you're earning 200k and below, you can consider yourself as a middle to low income earner. Now, understand that this is my personal perspective. Different financial analysts would advise differently. Some people would say 500k and below. Some people will say 100k and below. Some will even say 1 million and below. But my personal perspective, looking at the economy, the state of the economy, and purchasing power, I would say middle to low income earners are 200k and below. Now, I recommend that these classes or this set of individuals invest in money market instruments because of the quick return on investment and because of the fact that you are able to have your principal back. That's just the reason why I would recommend that a middle to low income earner invest in a money market instrument. It is very flexible, right? It's very flexible, and the time is very short. Remember that time value of money is very important. You don't want to lock up your funds in a particular place for a very long time. Why? Because there might be other opportunities that would come up later that you would want to invest in, that would give you a higher return on investment, that would give you higher percentages or higher rates. It is not advisable for someone that is just starting out his or her financial journey to carry up a huge chunk of his or her funds and lock it up in some sort of capital market investment. I don't advise that, right? I advise that you invest in short-term instruments so that you're able to get your principal back, you're able to get your interest back, and then you can roll over. You can compound this investment. Now, the power of investment is in compounding. What's the meaning of compounding? Compounding is interest on interest. Very basic, like this is just the very basic definition. So the first kind of instruments that you can invest your money in are treasury bills, right? The most popular kind of treasury bills that we know are federal government treasury bills. These instruments typically last for like 91 days and 182 days or 364 days, but it can never exceed 365 days. They are low risk. First of all, that's the first thing. They are very, very much low risk, and they are discounted instruments. So usually the government will sell these bills at a discount. That means you as an investor, you will purchase below the face value of what that particular instrument is. So for example, you want to invest 200,000 in a federal government treasury bill and there's a discount of 10,000 naira. So instead of putting in your 200,000, you're putting in 190,000, and the interest is usually paid upfront. And at the end of, or at the maturity of that particular treasury bill, you're getting back your 200,000, and you've already gotten your interest at the beginning of the investment. So that's something that you should know about treasury bills, right? Mostly, like, they're the most risk-free investments because they are backed by the government, and you can say that the Nigerian government will never owe you. I mean, it's not like they can run away with your money. So if you want to invest in something that is extremely low risk, you can go for treasury bills. The next instrument you can get in a money market are commercial papers. Now, commercial papers are usually issued by corporations if they want to raise quick short-term debt instruments, right? Or if they want to raise quick money. And commercial papers are also issued at a discount, right? And commercial papers, as regulated by SEC, that's Securities and Exchange Commission, has a maturity of 270 days. That means that if you invest in a commercial paper, you are supposed to get your return on investment and your principal in nothing more than 270 days. Another instrument which is not very popular is a banker's acceptance. Now, banker's acceptance is usually issued by a company or a corporation, right? This is usually whenever they want to raise maybe money for export or trade activities. Yeah, so that's when companies would need to issue a banker's acceptance. And usually a banker's acceptance is guaranteed by a bank, which is why it's called a banker's acceptance, right? So if a Nigerian company, say maybe a Dangote, right, wants to issue a banker's acceptance with a face value of 100,000, right, to probably maybe finance the import of a raw material, and you as an investor, you want to invest in that banker's acceptance, you will purchase that banker's acceptance at a discount, because they're also discounted instruments, maybe at a discount of 90k instead of 100k. And when the banker's acceptance matures, you are getting your 100k. Okay, so it's almost similar to a commercial paper and a treasury bill. There are a couple of others like term deposits, promissory notes, but my absolute favorite, which is going to be the last I'm going to talk about in this video, are mutual funds. Mutual funds are like a pool of investments, right? Where you have commercial papers, you have T-bills, you have banker's acceptance, you have all of these instruments put together as one investment. So usually mutual funds are managed by fund managers or asset managers, right? And the benefit of mutual fund is this: it helps to balance the interest, right, that you get from each of these instruments, had it been that you invest in them individually. You just put your money, or you give your money to a fund manager or an asset manager, and what they do is that they are able to balance your investment, right, by spreading, by investing in all of them. It's like investing in a bucket of all of these securities or these instruments, so that they're able to balance the risk and the return of investing in each of them single-handedly, or like differently. And the benefit of this is this: if you are maybe a new investor, right, I personally would recommend that you go for a money. Very briefly, I'm just going to show you guys a platform that I recommend you can use to get money market instrument or short-term instrument.
So this is a platform where you can get money market instrument at any amount, and you can see the various instruments that are already listed on this platform. These are the federal government treasury bills with their various maturity rates, dates and rates, and these are some fixed deposits. And this is a platform where you can invest in mutual funds. So that is the interface where you can track your investments, your transactions, the amount that you've withdrawn, and all of that.
I hope with these very few points of mine, I've been able to convince and not confuse you of the benefits of investing in money market instruments. So please like, share, and subscribe to this channel. And I hope to see you in the next video. Bye.